In just 5 years, the concept of the starter home will be mathematically extinct. You have been told that the housing market is frozen because interest rates are too high. You have been told that if you save your cash and wait for the Federal Reserve to pivot, prices will come down. That is a lie. The market is not waiting for you. It is being captured. According to a quiet forecast released by MetLife Investment Management, institutional investors are on track to control 40% of all single-family rental homes by 2030. That is 7.6 million homes removed from the ownership market forever. This is not a conspiracy theory. It is a published business plan. In the third quarter of 2025 alone, while regular families were priced out by 7% mortgage rates, investor activity rose to 30% of all single-family home purchases. Think about that number. Nearly 1 in 3 homes sold in America right now is not going to a family. It is going to a portfolio. While you're trying to qualify for a mortgage, companies like Invitation Homes are bypassing the bank entirely. In Q3 2025, they reported a revenue jump of 4.2% because they have the ultimate advantage: cash. We are not witnessing a bubble that will pop. We are witnessing a transfer of wealth that will stick. We are moving from a society of owners to a society of tenants. And if the data for 2030 holds true, the landlord of the future will not be a person. It will be a ticker symbol. To understand the gravity of the MetLife warning, you have to look at the trajectory. In 2022, institutional investors owned roughly 5% of the single-family rental market. That sounded small. It allowed the media to dismiss the threat as a niche strategy. But the MetLife report reveals the exponential curve. They forecast that by 2030, this number will hit 40%. This is not linear growth. This is a hostile takeover. This creates a price floor for the entire market. When one entity, or a cartel of entities, owns 40% of the supply, they don't just follow the market price. They set the market price. They can withhold supply to keep rents high. They can algorithmically adjust pricing across millions of units simultaneously. You're no longer negotiating with a landlord who needs to cover his mortgage. You're negotiating with a monopoly that has endless liquidity. The media calls this a housing crisis. But the Wall Street firms buying your neighborhood call it an asset class. They call it the single greatest opportunity for yield in the 21st century. And the terrifying part isn't that they are buying the homes, it is how they are funding it. They have turned your monthly rent check into a financial derivative that is being traded on Wall Street right now. But how are they winning? The common excuse is cash offers. But cash is just the ammunition. The weapon is the software. While you are browsing Zillow on your phone, firms like Invitation Homes are using automated valuation models, or AVMs. These are algorithms that process tax records, neighborhood crime rates, and rental yield potential in milliseconds. When a house hits the market, you have to call your realtor, schedule a viewing, and wait 5 days for an appraisal. The algorithm has already underwritten the deal, calculated the 10-year profit margin, and sent a binding cash offer before you have even put on your shoes. This speed removes the human premium. They don't need to fall in love with the kitchen. They only need the math to work. And because they rely on data, not emotion, they rarely overpay, but they always win the speed war. But why is there so much cash flooding into this sector? To understand that, you have to look at the bond market. In 2008, the economy crashed because of mortgage-backed securities. Banks bundled risky loans and sold them to investors. When the homeowners stopped paying, the bonds became worthless. Today, Wall Street has invented a new derivative. It is called the rent-backed security. Here's how it works. Invitation Homes buys 1,000 houses. They fill them with tenants. Then they bundle the monthly rent payments into a bond and sell it to pension funds and insurance companies. This changes the entire incentive structure of the housing market. In the past, a landlord raised rent to cover repairs or taxes. Now the corporation must raise rent to satisfy the bondholders. If they miss their revenue targets, the bond rating gets downgraded. This creates a permanent pressure to increase prices, regardless of the local economy. They have effectively financialized your monthly rent check, turning it into a yield product for a retiree in Norway. This suggests that rent prices will not go down, even if housing demand softens. They can't. The bond market demands they go up. But you might be asking, where's the government? Why are regulators allowing a handful of companies to corner the market on shelter? The answer lies in the lobbyist disclosures. In 2024, the trade groups representing institutional landlords spent over $80 million lobbying Congress. They aren't just protecting their business, they are writing the laws. Specifically, they are fighting to protect a tax loophole known as the depreciation deduction. Here's the scam. When you own a home, you pay taxes. When Invitation Homes owns a home, they depreciate the asset on their taxes, claiming the house is losing value every year, even while the market price is skyrocketing. This allows them to report a paper loss to the IRS to avoid paying taxes, while simultaneously reporting record profits to Wall Street to boost their stock price. They are using the tax code to subsidize their takeover of your neighborhood. The government is not a passive observer in this new feudalism. They are the silent partner. By keeping interest rates artificially low for a decade and refusing to ban bulk buying, they effectively handed the keys of the American middle class to the highest bidder. Most people focus on the giants like BlackRock, but the data from late 2025 reveals a new, more dangerous predator, the medium-sized investor. These are syndicates owning between 10 and 99 properties. While the megafunds paused their buying in early 2024 due to public scrutiny, these medium-sized predators accelerated. By late 2025, their market share ramped up to nearly 11% of all purchases. This is the swarm. They are funded by private equity but fly under the radar. They don't buy skyscrapers. They buy the 3-bedroom ranch in the suburbs. They are the reason you are losing bidding wars on fixer-uppers. They aren't looking for a home. They are looking for a yield-generating asset to bundle into a portfolio. Once they own the home, the model changes. They don't just want rent. They want to monetize your lifestyle. Look at Invitation Homes. In their Q3 2025 report, they didn't just brag about occupancy, they bragged about ancillary revenue. This is the subscriptionification of housing. Smart locks, air filter delivery, utility management fees. They are turning a house into a service. You pay for the privilege of unlocking your own front door. This increases their revenue per tenant without them having to buy a single new property. It is the ultimate rent-seeking behavior. You are paying off their investment, funding their tech upgrades, and covering their management fees, all while your own equity sits at zero. But the final nail in the coffin is the supply chain itself. It is called build to rent. Since 2019, the number of homes built specifically for investors has exploded by 134%. Builders prefer this model. Why sell one house to one family and deal with a mortgage contingency? They can sell an entire subdivision of 200 homes to a single fund with one check. In 2025, we saw a massive shift toward build-to-rent townhomes. This is the entry-level inventory that used to be the stepping stone for the middle class. Now, it is an asset class for invitation homes. The housing shortage is a myth. The homes are being built. You just aren't allowed to buy them. If you want to see where this ends, look north. Canada is roughly 5 years ahead of the United States in this cycle. In Toronto and Vancouver, the decoupling of wages from housing costs is complete. The average home costs nearly 10 times the average income. In Canada, they didn't stop the corporate consolidation. As a result, they have moved to a model where multi-generational renting is the norm. We are seeing the Canadianification of the American Sunbelt. The same metrics that broke the Toronto market, high immigration, low supply, and massive institutional capital, are now present in Florida, Texas, and Arizona. The American middle class was built on the 30-year fixed mortgage. It was a forced savings account that allowed a factory worker to retire with an asset. If that mechanism is broken, the wealth gap doesn't just widen, it becomes a canyon. We are risking the creation of a landed gentry, where wealth is determined not by what you do, but by what your parents owned before 2025. There is a dangerous misconception that we are in a bubble similar to 2008. People are waiting for the crash, thinking that when the recession hits, these corporations will be forced to sell. This is wishful thinking. In 2008, the sellers were distressed homeowners who couldn't pay their mortgages. They were forced sellers. Today, the owners are capitalization-rich funds with long-term debt locked in at low rates. They are not distressed. If the market dips, they don't sell. They buy more. We saw this happen in late 2022. When rates rose and prices softened slightly, regular buyers pulled back. The institutions viewed it as a discount window. Furthermore, in 2008, we had a massive oversupply of homes. Today, we have a structural shortage of roughly 4 million units. When you combine a structural shortage with deep-pocketed owners who never have to sell, you don't get a crash. You get a squeeze. The prices don't reset. They simply plateau until inflation catches up, leaving the average wage earner permanently behind. This is not happening everywhere. It is a targeted strike. The data shows investors are concentrating their fire on the Smile States, the Sunbelt regions where jobs are moving. They know you have to move there for work, and when you arrive, they will be waiting. You will find the house you should have been able to buy is listed for rent by the corporation that outbid you. You are trapped in the geography of their choosing. History is rhyming. In the Middle Ages, the serfs worked the land but owned nothing. The lords owned the land and collected the rent. Today, the serf is you, and the lord is a real estate investment trust based in Dallas. The data from Q3 2025 is the warning signal. The 40% prediction by 2030 is the destination. The question is not when will prices drop. The question is who will be left to buy.